Why does this product behave so differently from what the pricing formula suggests? That is the question I am asked most often by treasury professionals encountering FX derivatives for the first time. It is not a technical question, and the answer to it is the reason this book exists. FX options, pricing, hedging, exotics, risk, and institutional practice. Book 2 of the Foreign Exchange Markets Professional Series by Luigi Pascal Rondanini. FX options are priced using models. Every model is a simplification. The gap between the model's assumptions and the market's actual behavior is not a deficiency to be apologized for. It is the territory in which professional skill operates. Understanding where the Black-Scholes framework works well and where it fails, knowing when a local volatility surface provides adequate hedging and when stochastic volatility is essential, recognizing the conditions under which a calibrated SABR model is producing reliable parameter estimates versus generating numerical artifacts. These are the competencies that distinguish a practitioner from a technician. This book grew out of 25 years of explaining FX derivatives to clients, and before that, a decade of trading them. The frameworks in it are the ones I have used to help corporate treasurers design hedging programs, to advise risk managers on their options books, and to structure transactions for clients who needed risk profiles that vanilla products could not provide. My co-author on book 1 of this series is David Axtell, who has spent 35 years trading FX across London, Riyadh, Doha, and Dubai, and who hosts the Trading Floor podcast. He wrote a foreword to this book. This is some of what he said. There is a particular kind of knowledge that can only be earned on a trading floor. Books can describe the mechanics of an FX option, explain the mathematics of a volatility surface, and walk through the logic of a barrier structure. But the questions that separate a competent technician from a genuine markets professional are different. What does the smile actually tell you about positioning when you are quoting a large out-of-the-money put? How does a risk reversal feel when it is working against you and the spot is moving? When does the model stop being a useful approximation and start being a source of risk in its own right? Most books never ask those questions. This one does. A corporate treasurer who misunderstands their option strategy does not merely face an accounting adjustment, they face a material cash flow impact at the worst possible moment. A risk manager who cannot read the Greek's ladder is not managing risk. They are hoping it manages itself. A trader who cannot distinguish between model risk and market risk will discover the difference at significant personal and institutional cost. That is the book. Now, how it opens. The foreign exchange options market is where currency risk gets priced. Several $100 billion of notional trade through it every day, from corporate treasurers hedging receivables to macro funds expressing central bank views. Unlike the spot and forward markets, where participants trade the underlying currencies directly, FX options provide the right, but not the obligation, to exchange currencies at predetermined rates. Option buyers pay a premium to limit downside risk whilst retaining upside potential. That asymmetry creates risk management and speculative opportunities unavailable through linear FX products. Take a corporate treasurer. An exporter expecting to receive euros, reporting in dollars, is economically long the euro. A forward contract eliminates both the downside and the upside. An option preserves the upside whilst protecting the downside at the cost of a premium. Which one is right depends on the exposure, the hedging policy, and how certain that cash flow really is. That judgment, not the formula, is where the value of this book sits. Or take a hedge fund. A volatility trader is not making a directional call on a currency at all. They are exploiting mispricings in the surface itself. Buying underpriced out-of-the-money options whilst selling overpriced near-the-money options. Collecting premium on one leg, dynamically hedging the delta, and isolating the exposure that is actually mispriced. It is a different discipline entirely from the exporter's hedge, running on the same instruments, priced off the same surface. FX derivatives markets are technically demanding and commercially consequential. I hope this book earns its place on your desk. FX options, pricing, hedging, exotics, risk and institutional practice, publishes September 2026 through Rondanini Publishing. Details at rondanini.com/FX-options. Mind the gap between the model and the market.